feeling, right? Wanting to save a bit more cash each month. We all get it.
Hmm.
And if you own a home, refinancing your mortgage, well, that often comes up as a way to do just that.
It definitely does.
So for this deep dive, we're really digging into the whole refinancing picture, the history, what might be coming up. If you've ever wondered, when or how you could maybe lower those payments, this is for you.
Yeah, and look, trying to figure out mortgage rates can feel, well, a bit overwhelming, like trying to guess next week's weather sometimes.
Yeah.
So our goal here is just to cut through some of that noise. We've pulled together quite a bit of mortgage rate data going back 4 decades, analysis of the economic stuff that makes rates move,
Right.
and also what some experts are predicting for the near future.
Yeah, we're not just going to dump a load of stats on you. The idea is to give you the tools, sort of, to understand when those refinance windows opened up in the past, how the whole process actually works, and maybe most importantly, how you can try and spot potential chances to save money down the road without needing an economics degree.
Definitely.
Okay, let's dive in. History first. What can looking back tell us about when these opportunities tend to pop up?
Well, it's fascinating, actually. There's this cyclical nature to mortgage rates, and it's really closely tied to what's going on in the wider economy.
Okay.
If you look at the big picture, say since 1971, the average 30-year fixed rate has been about 7.71%.
Wow, okay. That's a good benchmark.
It really is. It helps you see when rates were, historically high or unusually low.
Right, so let's rewind, say 40 years, mid-'80s. What was happening then?
The 80s. Well, you had incredibly high rates early in the decade. I mean, peaking over 18% at one point.
Whoa.
Yeah, but then things started coming down. By 1985, the average was still pretty high, 12.43%.
So steep.
Very. But then, you see, by 1986, the average dropped to 10.19%, and in early 87, it even dipped under 10%.
Okay, so that's a noticeable drop.
Huge. If you'd bought a house with, say, a 13% mortgage just a couple of years earlier, this was a big deal.
Let's try and make that real. Like, what kind of savings are we talking?
Okay, let's imagine someone had a $70,000 loan at 13%. If they refinance down to 10%, their monthly payment, just principal and interest, could drop by about $161.
$161 a month. That's not nothing.
Right. Now, you have closing costs. Let's say they were around $2,450 back then for that loan size.
Okay.
If you divide those costs by the monthly savings, you get your break-even point.
Yeah.
In this case, it works out to about 16 months.
So after just, a year and a bit, they'd actually be saving money overall.
Exactly. Once you pass that break-even, it's pure savings each month.
Gotcha. Okay, moving forward a bit, early 90s. What was the story then?
Early 90s, you had an economic recession. And typically during a recession, the Federal Reserve steps in.
They cut rates, right, to try and stimulate things.
Precisely. They lower interest rates to encourage borrowing and spending. So in 1990, the average 30-year rate was still around 10.13%.
Yep.
But because of the Fed's actions, rates fell pretty significantly in 92 and 93. The average for 93 was down to 7.31%, and some months saw rates even lower, in the low 7s.
Another window opens up.
Yep. Another opportunity.
Let's run the numbers again. Maybe a slightly bigger loan this time, say $100,000 going from 10% down to 7.5%.
Okay. That homeowner would likely save around $179 a month on their payment.
Nice.
And if we estimate the closing costs at maybe $3,500,
Right.
the break-even point would be roughly 20 months.
Okay, so a bit longer to recoup costs that time, but still potentially very worthwhile.
Absolutely. If you planned on staying put, it made a lot of sense for many people.
Okay, fast forward again. Late 90s, early 2000s, tech bubble bursting. What did that do to rates?
Right. So after the tech boom went bust around 2000, the economy slowed down again. Rates had been around 7.4% in 99, actually ticked up to 8% in 2000.
Oh, interesting.
Yeah, but then the slowdown really kicked in.
Yeah.
And rates started trending down from 2001 through 2003.
How low did they get?
The average for 2003 hit 5.83%, and monthly averages dipped into the low to mid-5s.
That's a pretty big drop from 8%.
It is. So let's say you had a $150,000 mortgage at 8%. Refinancing to 5.75% could save you around $226 a month.
Okay, and the break even?
With estimated costs, maybe $5,250 on that loan, you're looking at a break even of about 24 months, 2 years.
So a recurring theme here. Economic bumps lead to rate drops, creating these refi windows.
That's a big part of the story, yes.
Let's jump closer to the present the last 20 years. The Great Recession starting around 2008, that must have had a massive impact.
Oh, huge. Unprecedented, really, in terms of the policy response. Financial crisis led the Fed to take really aggressive steps to lower borrowing costs across the board.
Where were rates just before it hit?
In 2007, the average 30-year fix was around 6.34%. Still relatively low historically, but about to change dramatically.
Oh, they plummeted.
Pretty much. From late 2008 right through 2012, rates just kept falling. The average in 2012 hit what was then an all-time low, 3.66%.
Wow. Under 4%.
Yeah. Caused a massive, massive wave of refinancing. I mean, everyone who could was looking into it. It really showed how much power the central bank has in a crisis to influence borrowing costs. That was kind of new territory for many homeowners.
So someone who maybe bought or refinanced before the crash, say at 6.5%, what could they save going down to? Maybe 4%. Let's say on a $200,000 loan.
Okay, at 4%, they could have been saving somewhere around $309 every single month.
That's substantial.
Very. And the break even, estimating costs around $7,000 for that size loan.
Yeah.
It's about 23 months. So less than 2 years again.
Really significant savings and a quick payback. What about the period after that initial crash and recovery, say 2013 to 2019? Rates stayed low then, didn't they?
They did, yeah. Historically very low, but not quite as rock bottom as 2012. There was a bit more volatility.
Like what?
Well, 2014 averaged 4.17%. 2018 was up a bit to 4.54%. But within that period, there were dips. Like in 2015, the average was 3.85%. 2016 was even lower at 3.65%. And then again in 2019, it dipped back under 4% to 3.94%.
So smaller opportunities maybe, but still chances for some people.
Exactly. Maybe not the huge savings like dropping from 6.5% to 4%, but still potentially worth looking at depending on your situation.
Can you give an example for that period, like a smaller rate drop?
Sure. Let's say you had a $220,000 loan at 4.5% and you saw rates dip to 3.75%. You could refinance.
What would the savings look like?
Monthly savings would be around $93. Still helpful, but, smaller.
Right. And the costs?
Costs might be around $7,700. So you do the math. $7,700 divided by $93.
That sounds like a much longer break even.
It is about 83 months. It's almost 7 years.
Wow.
Yeah. So this really highlights how crucial that break-even calculation is. A smaller rate drop might look tempting, but if you sell the house before you hit that 7-year mark, you actually haven't saved any money. You might have even lost some.
Really important point. Always got to run those numbers for your specific situation.
Always.
Okay, now the last 10 years. This brings us to the wild ride of the pandemic.
Yeah, wild ride is a good way to put it. The COVID-19 pandemic and the huge economic response, all that stimulus money, it sent mortgage rates to places they'd never been before. All-time lows.
Where were we just before that hit, like 2019?
2019 average was 3.94%. Already pretty low.
And
then they just tanked. Rates went below 3%. The absolute record low was hit in January 2021, 2.65% on average for a 30-year fixed.
Unbelievable.
Yeah. The average for all of 2020 was 3.10%, and for 2021, it was 2.96%. It was just prime time.
Yeah.
A huge number of homeowners refinanced.
Give us a sense of those savings, like someone going from maybe 3.9% down to 2.85% on a $300,000 loan.
Okay, that could save them around $174 a month.
And the break even cost would be higher on a bigger loan, right?
Right, maybe $10,500 in cost. So the break even works out to about 61 months, or just over 5 years. Still very good for locking in such a low rate.
Yeah, and you mentioned people saving even more compared to long-term averages.
Oh, absolutely. If you compared someone refinancing to under 3% with someone holding an older mortgage closer to that long-term 8% average, I mean, the savings could easily be $600, $700 a month, or even more, depending on the loan size. Just massive differences.
Truly historic lows. But of course, that didn't last. Things changed fast in 2022, 2023.
Very fast. Inflation shot up, became the big worry. And the Fed reacted.
Right.
They started hiking interest rates aggressively to cool things down.
And mortgage rates followed.
They sure did. We went from rates around 3.2% in January 2022 to over 7% by October of that same year. Just a massive surge. The average for 2023 ended up being 6.81%.
So for most people who'd already refinanced or bought at low rates, that refi door slammed shut pretty quick.
Pretty much, yeah. For the vast majority, the opportunity was gone. The only folks maybe still looking were those who unfortunately bought or refinanced right near those peaks in late 22 or early 23. Even then, subsequent small dips needed very careful calculation against the costs.
Okay. So, looking back, it's crystal clear. Big economic events, especially recessions or crises that cause the Fed to slash rates, those are the prime times these refi windows really open wide.
That's definitely the historical pattern, yes.
Yeah.
Major rate drops are the key trigger.
Right. So, now that we've got that historical context, let's get into the nitty-gritty. The mechanics of refinancing. It's not just about the rate, is it?
No, not at all. There's more to it.
So why do people actually do it? What are the main motivations?
Well, number one, far and away, is getting that lower interest rate to get a lower monthly payment. That's the big one for most people.
Makes sense. What else?
Some people refinance to change the loan term. Maybe they have a 30-year mortgage, but now they can afford a higher payment, so they refi into a 15-year
Why do that?
to pay the house off much faster.
Right.
And save a ton of interest over the life of the loan, even though the monthly payment goes up.
Okay, gotcha. And then there's taking cash out. We hear about that sometimes.
Right. Cash out refinancing. That's where you borrow more than you currently owe using the equity you built up in your home. You get the difference as cash.
And people use that for, what, home improvements? Debt?
Yeah, renovations are common. Consolidating higher interest debt like credit cards, college costs, lots of reasons. But it's important to know cash out refis often come with slightly higher interest rates than a simple rate and term refi.
Good point. What about changing the type of loan?
That's another big one, like switching from an adjustable rate mortgage, an ARM, to a fixed rate mortgage.
Especially if you think rates are going up.
Exactly. Lock in that certainty. Or, less commonly, maybe going from fixed to an ARM if you think rates will fall or you plan to move soon anyway,
Yeah.
before the rate adjusts.
Okay. And one more, getting rid of PMI.
Yes, private mortgage insurance. That extra cost, if you put down less than 20% initially on a conventional loan, once your equity reaches 20%, meaning your loan balance is 80% or less of the home's value, your LTV.
Loan to value, right.
All right, LTV. Once you hit that 80% LTV mark, either by paying down the loan or because your home value went up, you can often refinance to ditch that PMI payment.
So quite a few reasons someone might look into it beyond just chasing a lower rate.
Definitely.
But, okay, let's talk costs. It's not free, right? What does refinancing typically cost?
No, definitely not free. You're basically taking out a whole new loan, so you have closing costs again, similar to when you bought the house.
And how much are we talking, roughly?
It varies, but a general range is somewhere between 2% and maybe 6% in the new loan amount.
2 to 6%. So on a $200,000 loan, that could be anywhere from $4,000 to $12,000.
Exactly. It could be a pretty significant chunk of change up front.
Yikes. What kind of fees make up that total?
Well, you've got a bunch of potential fees. There's usually an application fee, maybe $75 to $500, a loan origination fee, often a percentage, maybe 0.5% to 1% of the loan. Then the appraisal fee to figure out your home's current value, maybe $225 to $700, or even more in some areas. Title search and title insurance, that's another few hundred, maybe $400 to $900.
Right. Checking the property ownership history.
Yep. Recording fees to file the new mortgage, usually small, $25 to $250. Credit report fee, $50 to $80. And then there are discount points.
Yes, points. Let's talk about those in a sec. Any others?
Sometimes attorney fees, survey fees, flood certification fees. It depends on the lender and your location.
Okay, so quite a list. And this brings us back to that break-even point we talked about with the historical examples.
Absolutely critical. You have to figure this out.
How do you calculate it again?
Simple formula. Take your total estimated closing costs, everything added up,
Right.
and divide that number by the amount you expect to save each month with the new lower payment.
Okay, so if costs are $5,000 and you save $200 a month?
Exactly. $5,000 divided by $200 equals $25. That means it will take you 25 months to recoup your closing costs.
And the key is you need to plan on staying in the house longer than that break-even period to actually benefit.
Precisely. If you sell or refi again before month 25 in that example, you haven't actually come out ahead from the refi itself.
Makes total sense. Now, about those discount points, what's the deal there?
Okay, so discount points are basically prepaid interest. You pay an extra fee up front, usually 1% of the loan amount per point, in exchange for getting a lower interest rate on the loan.
So you pay more now to pay less later, essentially.
That's the idea. But because you're paying more up front, it increases your total closing costs.
Convenience.
It pushes out your break-even point. It'll take you longer to recoup those higher initial costs, even with the lower monthly payment.
So paying points only really makes sense
if you are very confident you'll be staying in that home with that mortgage for a long, long time, long enough to not only break even, but also enjoy significant savings from that lower rate over many years.
Got it. So given all this, the rate drop, the cost, the break even, how do you know if a refi offer is actually a good deal for you?
Well, there's that old rule of thumb people mention, sometimes the 0.75% rule.
Meaning the new rate should be at least 0.75% lower?
Yeah, that's the general idea. It's a starting point, maybe,
Yeah.
but honestly, it's a bit too simplistic.
Why is that?
Because it doesn't account for everything else. Like, your specific loan amount matters hugely. The actual closing costs where you live matter. Appraisal fees can be higher in areas with higher labor costs, for instance.
Right.
And crucially, how long you plan to stay in the house. That personal break-even calculation is way more important than a generic percentage rule.
And the loan size itself affects the math too, right?
Absolutely. On a really big loan, those percentage-based fees, like origination, add up to more dollars, which can stretch out the break-even.
Okay.
Conversely, if you only owe a little bit left on your mortgage, say $50,000, even a decent rate drop might only save you, I don't know, $30 a month. The savings might just not be big enough in dollar terms to make paying thousands in closing costs worthwhile.
Good point. What about having equity? Does having a lower loan-to-value ratio help when you refinance?
It definitely can. Lenders see lower LTV, meaning you own more of your home outright, as less risky.
So they might offer better rates.
Often, yes. You might qualify for a slightly better interest rate. And as we mentioned, if your LTV is below 80% on a conventional loan, you get to stop paying that PMI, which is a direct monthly saving right there.
Okay. So bottom line, it's super personal.
Totally. A big drop in market rates is usually the trigger, the thing that makes you look. But whether refinancing actually makes sense for you depends entirely on your numbers, your costs, and your plans. You got to do the homework.
Makes perfect sense. Okay, we've covered the history, we've covered the mechanics. Let's shift to right now, May 2025. What are mortgage rates actually looking like today?
Okay, so as of late May 2025, we're seeing average 30-year fixed rates generally hovering somewhere between, say, 6.8% and 7.0%. Maybe a touch higher if you look at the EPR, which includes fees.
And how does that compare?
Well, it's definitely lower than the peaks we saw last year when rates went well above 7%.
Okay, some relief then.
Some, yeah, but still way higher than those crazy low rates of 2020 and 2021. And actually pretty close to that long-term historical average we talked about earlier, that 7.71%.
Right, so not historically low anymore, more like historically average.
The average-ish, yeah. That's a decent way to put it. The super low rate party is definitely over for now.
So what's keeping rates in this range? What are the big economic factors driving things right now?
Well, inflation is still a huge piece of the puzzle. The latest numbers for April 2025 show inflation around 2.3% overall, maybe 2.8% for core inflation.
And the Fed wants it at 2%.
Exactly. So inflation is closer to the target than it was, but maybe still a bit sticky, a bit higher than they'd like. And as long as that's the case, it puts pressure on the Fed to keep interest rates relatively high to prevent inflation from flaring up again. That tends to keep mortgage rates elevated too.
Okay, so inflation's one. What about the Fed itself, their policy decisions?
Crucial. The Fed doesn't set mortgage rates directly, but their main policy tool, the federal funds rate target.
That's the rate banks charge each other overnight.
Right. That rate, and just as importantly, what the Fed says about its future plans, heavily influences yields on government bonds, especially the 10-year Treasury bond.
And Treasury yields and mortgage rates tend to move together.
Very closely, yeah. Think of them as competing investments. So right now, the Fed's FOMC just decided in May to keep their target rate steady in the 4.25% to 4.50% range. They're basically saying, we need to see more proof that inflation is truly heading down sustainably before we start cutting rates. That cautious stance keeps bond yields, and thus mortgage rates, from falling much.
Got it. What about the overall health of the economy? GDP growth? Jobs?
Yeah, those matter too. Current forecasts for GDP growth in 2025 are pretty modest, maybe 1.3% to 2.0%. Slower growth could eventually lead to lower rates if it signals less inflationary pressure.
And jobs?
The job market's still pretty resilient, though maybe cooling off a bit. Unemployment was 4.2% in April. Job growth numbers were okay, but maybe slowing down on average. Wage growth is also moderating slightly.
How does that feed into rates?
Well, a super strong job market can support housing demand and potentially keep rates higher. If the job market weakens significantly, that could push rates down, partly because it might make the Fed more inclined to cut rates to support the economy.
Okay. And you mentioned that 10-year Treasury yield again. Where is that sitting now?
As of late May, it's been hovering around 4.54%. Again, mortgage rates tend to follow that yield, plus a certain margin or spread. So anything that moves investor confidence, inflation expectations, or guesses about Fed policy will move that Treasury yield, and mortgage rates usually follow along pretty quickly.
So lots of moving parts influencing where rates are today.
Definitely.
Given all that, what are the experts predicting? Where might rates be heading for the rest of this year into 2026? Are we expecting a big drop?
The general consensus seems to be Probably not a big drop. More like conscious optimism for a modest decline.
Okay. Modest like what?
Well, forecasts vary a bit, naturally. Fannie Mae, for example, is projecting rates might end 2025 around 6.3% and maybe drift down to 6.2% by the end of 2026.
Okay.
The Mortgage Bankers Association, the MBA, they think rates could maybe hit the mid-sixes later this year, maybe around 6.6% by year-end. Some banks, like Liberty Bank, see rates staying somewhere in the 6% to 7% range through 2025.
So nobody's really calling for a return to those 3% or 4% rates anytime soon.
No, definitely not. The overall feeling is rates might ease slightly, maybe get into the low to mid-sixes over the next year or so if things go according to plan.
And if things go according to plan means what, mainly?
It really hinges on inflation continuing to cool off, getting closer to that 2% target and staying there. That's what would likely give the Fed the confidence to actually start cutting the federal funds rate.
And there's still quite a bit of uncertainty around that, right?
Oh, for sure. Economic forecasting is tricky. These are best guesses based on current data, but things can change. So it's important to see these as projections, not guarantees.
You also brought up something called the lock-in effect earlier. How does that play into the refinancing picture now and going forward?
Right, the lock-in effect. It's a really big deal right now. Think about all those millions of homeowners who refinanced or bought homes in 2020, 2021, maybe early 2022, and locked in rates below 4%, some even below 3%.
Yeah, huge number of people.
Exactly. So even if rates now drop from around 7% down to, say, 6% or even 5.5%, for those folks with a 3% mortgage, there's just no incentive to refinance. They're locked into those amazing rates.
So future refinancing won't be like the huge waves we saw before.
Probably not. It'll likely be much more targeted. The people who will benefit most from rates falling into the sixes are those who currently have higher rates. Maybe they bought in late 2022, 2023, or even early 2024 when rates were in the sevens or even touched 8%.
That makes sense. And that lock-in also affects people moving, right?
Absolutely. If you have a 3% mortgage, are you really eager to sell your house and buy a new one with a 6% or 7% mortgage? Probably not, unless you absolutely have to move. It's thought to be one reason why housing inventory, the number of homes for sale, has been tight. People are staying put.
Interesting side effect. Okay, so if you're listening to this, trying to make sense of it all, how do you connect the history we talk about with these future possibilities?
Well, history shows us these cycles, often driven by Fed policy responding to economic conditions. But, the post-pandemic world has some unique features. We have higher inflation concerns than we did for much of the 2010s, a lot more government debt. These things could change the old patterns.
So maybe the old playbook doesn't fully apply.
It's possible. That higher for longer narrative about interest rates isn't just talk. There are reasons why rates might not fall back as low or as fast as they did in past cycles. The key driver, though, remains the Fed. What they do next, based on inflation and job numbers, will be the main thing steering mortgage rates.
And what we're really looking for is the Fed signaling a sustained move to lower rates.
Exactly. A clear pivot based on confidence that inflation is truly beat. That's the main catalyst that would likely push mortgage rates significantly lower.
So let's talk scenarios. What needs to happen for rates to drop enough to make refinancing attractive again for more people? And what kind of time frame are we talking?
Okay, let's game it out a bit. Scenario 1, probably the most likely based on current forecasts. Inflation continues its slow grind down through 2025. The job market softens a bit but doesn't fall apart. Economic growth is just kind of moderate.
Okay. What does the Fed do then?
In that case, maybe the Fed feels comfortable enough to start making a few small quarter-point cuts to the federal funds rate, maybe starting late 2025 or into 2026. Nothing too aggressive.
And mortgage rates.
They could drift down into that low to mid 6% range we talked about, maybe 6.0% to 6.5%, perhaps by mid to late 2026.
Who benefits them?
Primarily people who currently have rates above 7%, maybe 7.5% or higher. That drop could be enough to meet that 0.75% or 1% difference rule of thumb after considering costs.
Okay, that's the likely path. What's a less likely but better for refinancing scenario?
Scenario 2. The economy slows down more sharply than expected. Maybe we skirt closer to a mild recession in late 2025 or 2026.
What happens then?
Then the Fed might have to cut rates more aggressively to stimulate the economy. In that case, mortgage rates could potentially dip further, maybe into the mid to high 5% range, say 5.5% to 5.9%.
And that would open the door for more people.
Oh, yeah. A drop into the fives would make refinancing worthwhile for a much larger group of homeowners, including many who bought or refinanced when rates were in the sixes or low sevens.
Okay. And the flip side. The least likely but worst case for refi hopes.
Scenario 3. Inflation proves stubborn or even reaccelerates. Or the economy stays surprisingly strong.
What would the Fed do?
They'd be forced to keep rates high or maybe even hike them again. In that world, mortgage rates stay stuck in the high sixes, sevens, or even go higher. Refinancing opportunities would be very limited.
Gotcha. So it sounds like instead of fixating on hitting some magic low number like 3%, the focus should really be on the spread between your current rate and what becomes available.
Precisely. Don't get anchored to those pandemic lows. They were an anomaly. Look at your current rate. If you have an 8% mortgage and rates fall to 6.5%, that's a huge win, even if 6.5% isn't 3%. It's about the improvement for you, weighed against the costs and your timeline.
And remember that sequence you mentioned.
Right. We need to see inflation stay down first. That gives the Fed confidence. Then the Fed cuts rates. That brings down Treasury yields. Then mortgage rates follow. Good inflation news is the first domino.
Okay. So for someone listening now, maybe thinking, okay, I might want to refi if rates drop a bit. What practical steps can they take now to be ready?
Good question. First, know your current mortgage inside and out. Rate, balance, term, type of loan. Have that info handy. Second, keep a casual eye on those key indicators we talked about. You don't need to obsess, but be aware of big inflation reports, CPI, what the Fed announces after its meetings, and maybe where that 10-year Treasury yield is trending.
Makes sense.
Third, do that personal break-even calculation now. Get a rough estimate of what closing costs might be in your area. Think realistically about how long you'll stay in the house. Know your number.
Good prep. What else?
Keep your credit score in good shape or work on improving it. Better credit means better rate offers when the time comes.
Crucial.
And when you do think it's time, shop around. Don't just go to your current lender. Get quotes from multiple banks, credit unions, online lenders. Rates and fees can vary.
Always good advice.
Consider all the loan options, but be careful with A-arms unless you fully understand the risks and it fits your specific short-term plans. And finally, don't drive yourself crazy trying to perfectly time the absolute bottom. If the numbers work for you, based on your break-even and your goals, and rates have made a significant dip, it might be time to act rather than waiting for potentially slightly lower rates that might never come.
Solid advice. Oh, and remember, refinancing isn't just about rates, right?
Exactly. If your home value has shot up, maybe a cash-out refi makes sense for consolidating debt or funding a project, even if the rate isn't dramatically lower. It's another tool in the financial toolkit.
Great point. Okay, this has been incredibly informative. Let's try and boil it down. What are the main takeaways for everyone listening?
I'd say, first, looking back, those big refi booms were clearly linked to major economic events causing rates to fall significantly. Second, understanding the actual mechanics, the costs, the fees, and especially calculating your personal break-even point is absolutely essential. It's not just about the rate. Third, where we are now. Rates are off their recent highs, but still elevated compared to the pandemic lows, kind of near the long-term average. There's potential for them to drift down modestly over the next year or two, but it depends heavily on inflation cooperating and the Fed acting.
And who benefits most from that potential drop?
Primarily folks who currently have higher rates, say, from mortgages taken out in the last couple of years when rates were in the 7% plus range. The lock-in effect means people with super low rates probably won't be refinancing anytime soon.
And the biggest takeaway of all?
It's got to be that the decision's deeply personal. You have to weigh the potential savings against the costs and your own financial situation, your goals, how long you'll be in the home. No substitute for doing your own homework.
Absolutely. Well said. And maybe one last thing to leave people thinking about. Beyond just saving money each month, which is great, if you do find a strategic refinancing opportunity that works for you, what else could that unlock? Think about it. What could you do with that freed up cash flow each month, or maybe with equity you'd access? Could it help fund other goals, investments, paying down other debt faster? It's worth considering those broader ripple effects in your financial life.
That's a great thought to end on. It's not just about the mortgage payment itself.